Hey gang, Dennis Tubbergen here. I'm here with another market analysis. Today is Thursday, April 19. And I have on the screen in front of you a chart from the Long Wave Group. You can check out their website at longwavegroup.com. It's run by Ian Gordon, and it's a really interesting chart. Because what we have here going all the way back to the mid-1880s is a chart of the Dow Jones Industrial Average priced in gold. And there's a couple things we can learn from this chart. One, the relationship between gold and stocks. It's definitely an inverse relationship, meaning that they tend to move in opposite directions. When stocks are up, gold tends to be down, and vice versa. When gold is up, stocks tend to be down. The other thing we can learn from this is that using the US dollar as a metric, or a measuring stick, if you will, for stock pricing is not really a very good metric. In fact, if you take a look at what's happened really since 1933, which is about here on the chart. In fact, at that time, Franklin Roosevelt, who was president at the time, ordered all Americans to hand in their gold, as you can see from the chart. The reason, of course, was that the government wanted to print paper currency to try to combat the symptoms of the Great Depression, and they couldn't have a real currency or real money like gold competing with them. Since that time, the U.S. dollar, depending on what numbers you want to look at, has lost somewhere between 95 and 98% of its purchasing power. So let's just, for today's purposes, say it's lost a lot of its purchasing power. Now, if you look at this chart shows the Dow Jones Industrial Average priced in gold. So to come up with the value to plot on this chart, you take the value of the Dow Jones Industrials priced in dollars and divide by gold priced per ounce in dollars. So the price of the Dow Jones Industrials in dollars divided by the gold price per ounce in dollars. Now you can see that back here in 1896 the ratio was 1. The Dow was at about 20 and gold was selling for $20 an ounce. By 1929, when stocks got really overvalued prior to the crash, that relationship got to 18. So if you divided the value of the Dow by the value of the price of gold per ounce, you got a number of 18. By the time the market bottomed here in 1932, that number reverted to 2. And by 1966, that number reached 28. However, by 1980, that number got back to 1. The Dow was at about 850 and gold was about $850 an ounce, having risen to $850 an ounce from about $35 an ounce in 1971 when President Nixon at the time closed the gold window, as you can see on the chart. Then, from 1980 to 1999, over those 2 decades, that ratio worked its way all the way back up to almost 44. That was the peak of the tech stock bubble. Now, if you take a look at where we're at today, as of close of business yesterday, the Dow closed at 24,712. Gold was at 1348. The ratio is about 18. Now, we expect that by the time this shakes out, that we're going to go back to a 1-to-1 ratio. So we're certainly bearish on stocks and bullish on gold. Now, we've had this forecast for several years. The intangible here is we don't know exactly what the Federal Reserve's policy response is going to be. There's a lot of newly created money that has found its way into stocks and real estate again, I believe. And as that works its way back out of stocks, I think you're going to see stocks correct. And I think you'll see what is a likely suppressed gold price go up. So that's today's market update. Hopefully it gives you some good perspective. I'm Dennis Tubbergen.